Hello, everyone. Welcome to the For Investors podcast, where we bring Wall Street to Main Street. I'm Andrew Gay, along with Gilbert Pies and Zachary Green, and we are the Texas Hill Country Advisors based in beautiful Kerrville, Texas. And we're here to give you our Main Street perspective on Wall Street today and the latest Wall Street happenings. So, happy Monday, everybody.
Happy Monday, Andrew.
Market just closed. We had a wild week last week. It was mostly positive. And then Friday, I actually was out Friday, but you two guys were here. So maybe we start there. You can tell me about your reaction to Friday's dip and sell off and then the bounce back today.
Sure. Yeah. Like you said, the market was bumping along just fine last week. Actually, we're in positive territory for most of the day. But then Friday morning, about 10:30, 11 o'clock, President Trump came out and said that he was thinking about reinstituting some extremely high tariffs on China, and that sent the market into a tailspin. Throughout the day, the market just went down, 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 and the three major indexes ended down over 2% by the end of the day, and so that took the market into negative territory for the whole week. It was a serious butt kicking. I think the market was reacting to the idea that they thought those trade tariff issues were already resolved and solved earlier in the year, right around March and February timeframe. But those fears creeped back up and reared their ugly head, and the market took a beating. But ironically, today, some of the tone shifted, I guess, and there were some geopolitical events that maybe helped to make the market sentiment change and feel better about what's going on. And so the market recovered most of their losses from Friday. And so, for good, better, and different reasons, we're pretty much flat if you count, last week and today. Remains to be seen what will happen with the rest of the week. But I think what we've got coming up here over the next couple of weeks is probably pretty important too. Today, we talked about how the stock market has probably already priced in a shutdown for 2 to 3 weeks. Well, we're running into the third week already. If this shutdown lasts any longer, it could be a problem. Although the market seems to have brushed off a lot of the worst fears about it. But if you pay attention to anything on the political front, the Trump administration is talking about doing a serious reduction in force, laying off permanently tens of thousands of government workers, which may or may not be the right thing to do at this time. So that's issue number one, I think, that we've got. We've got issue number two. We've seen gold prices spike substantially.
Zach and I were just talking about that earlier. I think it's over $4,100 an ounce.
Right? Yes, $4,100 an ounce. That is an extreme jump. That should tell you right there that the market at least is, or at least some sectors of the market are thinking that the best place to find protection and a hedge in these uncertain times is gold, which, you could argue is a bit of a kick in the teeth to the US dollar if people aren't finding the US dollar as the safe haven to be, that they're turning to something like gold. So that's item number two.
And I heard a stat the other day that I think gold had passed, if I'm not mistaken, I think it was the $1,000 mark per ounce around the recession, and then didn't hit $2,000 an ounce until around COVID. So that means it's doubled since then.
Yes.
So significant run up in the last few years for gold. But go ahead. Sorry, continue.
Yes. We also have to look at the bond market. The bond market was closed today because today's a holiday. Yeah. But
what a segue.
Yeah, if you look at the bond market is sending some very mixed signals about what they expect over the next 6 to 12 months. I don't think it's a secret that the Feds are probably on a rate cutting cycle. Now, we can argue all day about whether or not it's justified, but it's what it is.
And two more are priced in between now and the end of the year. As far as the market expectations.
So, what is that going to do for future? And then I think item number four that a lot of people aren't really talking about right now is what are the impacts to the greater economy when we have a government shutdown and the release of government data is not very easy or forthcoming. We depend on government data to judge what we think is going to come in the near term, but also longer term. So whether it's unemployment, CPI, PCE, manufacturing data, PPI, which is the producer price index, a lot of government data is not being generated and distributed because of the government shutdown. And that's a serious problem because, the economists of the world can't use government data to come up with their own ideas about what's happening. And less information, less transparency equals, I think, more uncertainty,
Right.
which is a serious problem for the market. The market doesn't like that.
Right. There's already a level of uncertainty baked into it, right? But when it gets, ratcheted up to that level, it makes investors kind of a little weary.
For sure. I would say so.
Now, I wanted to mention the bond market again because and I said it was a segue from gold, because a lot of times you'll hear things like when things get wonky in the market, investors kind of have what they call a risk off appetite, and they'll move into things that they perceive to be less riskier assets. And case in point, gold and more specifically bonds in the bond market. So bonds have an inverse relationship from their yield. So what a lot of times is tracked, and you'll see quoted alongside market indexes, is the 10-year U.S. Treasury yield. So when that thing's going up, the money or is either going out of the bond market or bonds are being sold. But in times of risk off sentiment, you'll see money coming into the bond market, which will push the face value of those bonds up, and you'll see the yield actually come down. And so what we've seen a little bit of that over the last, I think, 3 to 6 months, because bonds have gotten whacked since 2022, and then just haven't really recovered since the Fed has been raising interest rates. Even with the first couple of cuts under the belt of the Fed, there still hasn't been a lot of relief in the bond market. But we have seen over the last 3 to 6 months or so, the 10-year U.S. Treasury yield come down from its highs, down closer to 4%. But we still haven't. It seems to be a hard resistance level. It has not broken below 4% quite yet. So one of the questions there is like, how much of the expectations of the rate cuts, if there's 2 expected that markets are expecting between now and the end of the year, is that already priced into that 10-year U.S. Treasury yield? Is it not? There's a little bit of uncertainty around that too. Mm-hmm. So,
and uncertainty makes a market. So
sure,
we just don't want crazy amounts of uncertainty. Right, that's where the issue comes up.
Right, and you get heightened levels of volatility when that uncertainty ramps up to that level. Right. Zach, what's got your attention currently?
What would you say if somebody's listening to us and saying, okay, well, what do I do? I'm scared.
Well, don't freak out. Definitely talk to someone.
Good
rule number one.
Don't freak out. Number one. Yeah, because if you freaked out on Friday and sold, you'd have missed today's run-up.
Mm-hmm. And it's really easy to freak out, I think. Looking at Friday's numbers, it was pretty scary. Everything's down 3%, and you're thinking it's just going to spiral from there.
You see that initial move, and it's kind of like, oh,
yeah,
right?
And all the headlines are talking about AI bubble. Is there a bubble? Is there not? Gold skyrocketing. Is the U.S. dollar going to poof? And I think just talk to someone trusted who's licensed, and make sure that you know what you're in and how you're invested and why you're invested there, and it'll work out.
Great answer, man.
I like that. Rule number one: do not freak out.
Do not freak out. Do not freak out. And it's like I told the ladies we were talking to this morning. It's like this is a good reason why you should have a dual license, right? Financial advisor kind of in your back pocket and someone to lean on and to go to for what? Advice. But more specifically, in times of uncertainty, you're like, oh, should I listen to this headline? Is the market going to keep spiraling out of control on Friday? Because if you looked at the headlines on Friday after that announcement and after the market was doing its thing, you're likely to feel something. So that's why it's important to have someone to talk to and say, okay, let's talk me through this. What's your opinion? Talk me off the ledge, if you will, and give me some reasoning why I should back up and not freak out.
And you know what we would tell you if you asked us, is the market going to continue to freak out? Is there a lot of uncertainty? if you're looking to us for definitive answers on some of those questions, guess what? We're going to be really short, sweet, and simple to the point. We have no idea. We have no idea how any of that stuff is going to resolve itself. But what we can tell you as financial advisors is that if you're patient, consistent, and take advantage of opportunities as they're presented to you, the market can do very, very well for you over the long term.
Yes.
And I think that's the key for everybody to understand. The long term. If you have some money and you can't devote at least 5 years to the investment, you shouldn't be doing it. Because as smart as we might think we are, we have no idea what's going to happen tomorrow, next week, next month. So you should not be putting your money into the market in any way, shape, or form if you can't give it at least 5 years. Now,
when you say that, you're suggesting that you need the 5 years to stay invested to let the thing do what it's going to do, right?
Exactly
so that means,
right.
Okay, yeah, I'm going to invest this money for 5 years, but 6 months in, I freak out. Well, that's not. You're saying it needs to have the intent to stay invested over that 5 year time period.
Let it marinate. Let it do its thing. And I was visiting with a prospect last week, and he's relatively new. He's been pushed kind of by family and friends to start investing in the market because he's got CDs, and CD rates are going down. He hasn't been able to make as much as he was making in CDs, so he wants other ideas, but he's afraid. And I told him, I get it. I'm afraid too, because I really don't know what's going to happen.
Yeah, you lose that insurance piece of that, and you go out from under the FDIC umbrella. All of a sudden, things aren't as certain as they were.
That's exactly right. So I told him, as a new investor, you should take it easy, slowly, first of all, and then consider strategies that will protect your downside, but still give you an opportunity for some growth. And so we talked about several ideas, and I'm not going to talk about what we talked about because I don't want anybody to misinterpret what I'm saying as a suggestion for them.
But if you're curious, you can come ask us.
Yes,
and
absolutely.
We'll be happy to have a one-on-one with you.
Yeah. So all you got to do is step out there a little bit. And there are a lot of opportunities out there that we can show you that don't cost a whole lot of money. They do require you to stay for a certain period of years. But also give you that flexibility for growth and downside protection. If you don't necessarily want the downside protection, then you can look at other ideas that have a lot of upside potential. But that's just it, potential. It's not a guarantee. So we've got to look at you've got to be willing to look at other ideas than maybe what you're usually used to if you really want to make a decent rate of return. And again, if you can give us 5 years, at least 5 years, we are pretty sure, very confident with a high degree of certainty that your investment will probably do reasonably well.
Well, the statistics say so, right?
Yes, exactly. Exactly.
Yeah.
Yeah, we're not going to quote numbers to you because I have no idea what you're going to do. I have no idea what's going to happen over the next few years. But what we can tell you is that statistically speaking, the longer you have, the longer your runway, the more time you can give us and let the investment marinate, the more likely you are to do well. And the well part is the part that we are not sure about because everybody's different. And what we do as advisors, right? We come up with a customized plan for you that's unique to you, nobody else. And so if you're not sure what you got,
which is what you need, because if you go on the internet, you take a bunch of blanket statements and the things that really are talking about trading and not investing at all. Well, you have no idea if that's applicable to you, if it even applies to you, or if they just want you to buy their book and their program.
I was going to say,
that's a lot of that.
My wife
most of it.
Yesterday showed me a video she found on Instagram, I think it was, this guy talking about his ideas for what's going to happen. And he was talking about, he was using fear. He was using get rich quick ideas. He was using ideas about, the US dollar and gold and life insurance and all kinds of other stuff. he was trying to motivate you, and at the very end of it, he says two things. He said, "There's only two things I would ask for you to consider: buy my program, buy my program, yeah, and you need life insurance, and here's the kind that you need." Well, guess what? The guy's a life insurance salesman. He's just using all this other
Yes.
stuff to motivate you to buy his program and get
Yeah.
your life insurance policy from him.
That's why, like, people like Robert Kiyosaki and wrote Rich Dad Poor Dad. Great book, great concepts, but at the end of the day, that guy is a marketer, a business person, and a salesman. That's what he is more than anything else. And case in point, I went to one of his little seminar things, just check it out and see what it was. And you click online, whatever you do, they hold it at some hotel and they get these people in there. all these people all they do is tell you to buy real estate, and, oh, we can provide you the contracts and we'll teach you how to have a good eye for it and find, vacant pieces of land that will sell at lottery ticket prices and all this kind of stuff. And then they use fear. News articles cut out in newspapers, right? Big banks doing this, stay away from the system. And then they say all of that to get you riled up and put it in your head. And then at the very end of it, they say, now for $13.99, just under $1,500, we can do this advanced program with you and you can buy this book. And then, dude, it's just like, it operates very similarly to like a multi-level marketing business model. And you just have to remember that, man, that you're getting sold.
This particular guy that was talking, this video that my wife showed me was, he was suggesting that you put money in life insurance policies. But what was funny was that he was bashing the US dollar as if the dollar was going to go to zero and the only place to be was in cryptocurrency and gold.
But nobody knows. Like, you don't know any better if you're the average person.
Well, the weird thing was that he's talking about these life insurance policies, but guess what those life insurance policies use to be sure that they can pay out their claims when they come
not
in.
Crypto.
They don't use crypto and they don't use gold. They use the US dollar.
Right.
So why are you telling me that the US dollar is crap, but I should put money into insurance policies that pay out in US dollars? That's like the gold people that always tell you the US dollar is going to zero and you need gold because that's the only thing that's going to matter.
Yeah.
If you truly believe that, why are you offering to sell me your gold and exchange your gold for my US dollars that you say are going to be worth zero?
Yeah.
It logically does not make any sense.
It doesn't compute.
Yes.
And that's why we say you need a dual licensed financial advisor, because we can talk to you about insurance products, we can talk to you about life insurance, and then we can talk to you about the investment universe too, and brokerage accounts and investment advisory accounts and the whole breadth of everything that's out there. Because if you went to someone that was only licensed in insurance, which we can still do, but they don't have the rest of the licenses that we have, and you ask them what's the best investment you can make, for your future, your family's future, what do you think the chances are that they're going to tell you it might be some kind of life insurance product? And why? It's not rocket science to figure that out. It's because they sell it. It's not complicated. Right. And yes, at the end of the day, we still sell you, investment and investment products, insurance products, whether it's life insurance, annuity, whatever it is. But the advantage that we have over everybody else is that we can see the entire universe and we're not beholden to any one of those groups or any one of those strategies. And we can really and truly talk to you about what's applicable for you and then match it to all of those things. And if you're not dual licensed, you're not licensed at all, or you're only licensed in one of those compartments, you can't talk about the other stuff. So, in the disadvantage, I think, that the common everyday Joe has, which, is frankly is most of us. And that's what we kind of like talk about on our podcast. Like, we live down here in Central Texas. We don't live on Wall Street. We're plugged into Wall Street through our broker dealer in the systems and stuff that we use. Right. But that person doesn't know the difference between any of that. So if you bump into a insurance salesman that says, hey, this is the best thing you can do, and let me tell you why, and it's a good enough story, you're going to feel compelled to do that, right? And you don't know any better. And so I think that's disadvantage to most of us walking around, that if you don't work in our industry, you're not a CFA, you haven't worked on Wall Street, you don't have that knowledge in your head. How are you supposed to know that stuff? Which is the reason, in my mind, a compelling reason why you should have a dual license independent financial advisor like us. And for the record, we don't want you to buy our program or book.
We don't have one.
We don't have one.
Maybe we should start one.
But we do. We would love for you to open an account with us if it makes sense for you to. And if nothing else, you are welcome to contact us, and we can spit education around the investment universe, investment and insurance products to you all day long. So that's kind of the thing that we're selling, is just conversations with us to educate the common person. But furthermore, we would love to do business with you if it makes sense. So no book or no program, but you're welcome to call us. Give us a shout.
Maybe that's the idea for the future. We'll come up with a program.
A book. Sell a book.
Yeah, sell a book.
Everybody's got a book.
Everybody's got a book. Sounds like a great idea.
Okay, I think that's it for today. Thank you guys for tuning in. Don't forget, interact with us. Share our content. Helps other people find our show. We're on Facebook, LinkedIn, and YouTube. Thank you so much. See you next time. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.